the main thing I use is return on equity to determine whether to sell or not versus cash on cash. For those of you that don't know me, my name is Ivan Barrett. I own a company here in Indianapolis, BAM. We are over 90 employees, about 300 million in assets, over 3,000 apartments we manage here in the Midwest. I started this thing in my spare bedroom with just a couple units, and I started my own investment portfolio with one duplex. Okay, so what is return on equity? Very simple. You take your cash flow from an asset, your real net cash flow, that's minus all expenses, holdbacks for capital improvements, that sort of thing, and you divide that into the actual equity in the asset if you were to sell it today, minus transaction costs, realtors, closing costs, that kind of thing. So for example, if you've got a duplex, you've got $100,000 of equity that you would walk away from the closing table with, and that duplex is, say, generating $2,400 a year, maybe $200 a month, your yield or your return on equity is actually only 2.4%, right? That's 2,400 into 100,000. So your money in that scenario is not working hard enough. And that's the situation that a lot of people are in right now because the market has gone up. People have forced appreciation by making improvements, and rents are going up. And so all of a sudden you've got this big pile of equity there, but the actual return on your investment is quite low. So this helped me determine when it was time to sell all my small assets and to keep buying bigger and bigger apartments. And it's a great equalizer for your own determination if your money's working hard enough for you. So we're seeing this a lot out there right now. It's pretty easy to figure out. It's taking your true cash flow on that deal and dividing it into the amount you'd walk away from the closing table with. Not how much before realtor commissions and closing costs and tax credit to the seller or buyer and those sorts of things. It's your true amount of equity you'd walk away with, and you're taking your cash flow on that deal. So if I've got an asset and it's not generating at least a 10, 12, 15% rate of return, for me, it's not working hard enough. And now, because of the new tax rules that came into effect in late 17, I can recycle that capital into a much larger deal, avoid the taxes, of course, legally, and not have to do a 1031, which is complex, has a tight time frame, and comes with a lot of fees and a few other red flags as well. Certainly a great method, but there's other solutions that are far more effective these days, helping a lot of clients with that. One, for example, they're going to walk away with almost $1 million by selling a small multifamily building in Florida right now. That's a lot of equity sitting there, and if they look at their cash flow, they're only making about 5% a year. That is not enough equity return for me to keep my equity locked up in a deal like that. Also, in this business, size does matter. So you've got a smaller deal that's much more susceptible to changes in cost, tenants trashing the place, residents just moving out and you have to redo it. Whereas a much larger asset, you've got better management in place, you've got better economies of scale, bigger reserves for when things go wrong, so on and so forth. That's it for today. Hope you're enjoying your Monday. See you next time.